Right? These markets are a puzzle. Right? We talk about some things like, even the nicey and the nasty that I just covered. Well, that's just a piece of the puzzle, right? There's not going to be one thing that is going to tell me, hey, that's it. This is, this is where you should go long or go short. It's going to be a combination of things. The Fed is a big thing, right? You hear that phrase all the time. Don't fight the Fed. Marty Zweig said that, right? It's very much what we're experiencing right now. Now, again, you still have to monitor for things because, look at what happened last week in the market, right? They were almost pricing in 100 basis point rate hike for coming in just a couple of weeks. The market didn't respond that badly to it, right? So there's some other dynamics going on right now. How much is already being priced into this market? What's going on with positioning? Right? Are people really leveraged to this market? Are they underweight this market? Are they short the market? All of these dynamics are different pieces of the market puzzle. So it helps to have some context to say, okay, yes, the Fed is still going to be raising interest rates. That doesn't make me want to go crazy into into risk and putting on risk while they're still doing that. But it could be that we're getting closer to the end of that, or maybe we're halfway through, we're some point. And again, I'm not making any conclusions by this, but the price action should be telling you something that, the market has been going sideways for a couple of weeks and even a couple months, right? We haven't, gone through the lows. Of course, little things like don't overtrade a tough market, don't short a dull market either. We talked about the 50-day moving average. Stocks, this is a big thing, right? So going through the monitoring and watching, believe it or not, you will see some stocks begin to march higher while the indices are still going lower or going sideways. You'll start to see things begin to outperform, right? And it can't just be one or two stocks, right? It's nice when one or two stocks do that, but you want to basically watch for some different, for groups, right? We've seen that a couple times when the S&P or the Qs have approached the 20-day moving average or 50-day moving average. And yes, you start to see more setups, right? But they've been some traps, right? And that's because, the Fed is tightening, right? And we're in a tightening cycle. So you've got to be aware that, hey, just because you're seeing, more setups than you were a week ago, right? They have to carry forward, right? They all can't stall, after a day or two of rally. Okay. So that's important too, right? And dipping a toe in rather than going, 20, 30% back into the market, because you've got to continue to monitor and watch and see how it plays out. Also watching the sectors. Right. I'm going to talk about scanning. That's the next thing I'm going to talk about. But that's my first scanner that I look at, once over the weekend. How many sectors are below the 50, the 200-day moving average, right? If they're all still below the 50 or 200-day moving average, right, that's not a lot of green shoots in the market, right? But if you start to see 3 or 4 sectors begin to kind of break higher, even though the S&P is still going sideways, well, maybe you might be onto something, right? What sectors are they? Are they the utilities and the consumer staples, right? Then that's probably not what you want to see, right? That's not the best sign or the healthiest of a market, is to see the consumer staples lead. Doesn't mean you can't trade the consumer staples, but for overall market dynamics, it's not probably something that you want to see. Right, and the setups in single stocks. Another thing I always get asked, and I take the requests all the time, chart requests, right? If you have to look at a chart for more than a couple seconds, right, and if it's not jumping out to you as a really good setup, then move on to the next one, right? You really want to see as you go through charts, like, wow, it should tell you just in a couple seconds that it looks really good, right? It's now beginning to come out of a sideways base. It's retaking a moving average, right? It's got a runway ahead of it where it doesn't have resistance right in front of it. If you can't determine that in a couple seconds and you're analyzing this chart for 30 seconds, it's probably not the best setup, right? And there's so many stocks, right, to go through. So it's not like, you don't have to just look at 10 stocks, right? Widen your universe. One way that you could do that, and again, like, I know that Richard's going to do a presentation on this. I love the Stan Weinstein book too, right? He talks about stage analysis, right? What stage is the stock in? 1, 2, 3, or 4, right? That's very simple. I think you should be able to see that very quickly, right? Going through your charts, what stage is this in? If it's still in stage 4, then, it may not be done going down, right? And I think that's another thing, going back to what I talked about in the beginning about, you know, making sure that this year has taught you, right? Going after names that are still not done going down, right? I saw, so many traders over the last year. I don't see them doing it anymore, but, I saw PayPal over the last, going back 4 months ago. Oh, this is a great setup. I'm like, really? How is it a great setup? The stock's in a downtrend. It's below the 20, the 50, the 200-day moving average. That's not even looking at the chart. If it's below those, there's no way it's a good looking setup. No possible way. So not to pick on PayPal, but there's been I don't say a million either, but there's a lot of stocks. They're not done going down, right? Because it's not being predictive. It's just saying, hey, this is still below all the moving averages, right? Know what stage it's in and whether or not it's moved on from a stage 4 to a stage 1. Very, very simple. So cutting the losers, right? No big losers. That is a huge thing, right? That can really, in a year like this, where we are in a bear market and the trend is down right now, if you continue to pile up big losers, right, it's going to be very difficult to come back from that, right? To be able to either have a positive year or outperform the market, right? So it's, having the big losers, that's something that you do learn over time, that you just can't have a lot of them, right? And especially in a more difficult market environment. All right. So that's a big thing. Also, the paper cut losses, like I don't mind the, having those small losers, but you have to be careful of those too. You don't want to keep piling up the paper cut losses. If that continues to happen, right, that's going to turn into this, right? That's going to turn into a big loser by, that. So it could be just the amount of trading that you're doing in a bear market, right? So I'll get to that in just a second too. Some tips about that. But riding the winners, of course, right? So that also has to come into your trading plan, right? How are you going to have some winners, right? In this market, it's tough because you get a winner and you want to grab it right now, right? You want to take it. That's not the worst thing to do right now in this market. But when the market does get a little bit more constructive, you are going to need to have those big winners, right, to average out. And that's how Jim Simmons does it too. Again, I'm not speaking for him or something, but if you look at the percentages, he has some really big winners that level out that 49%, losses that of, trades that he takes on onset. Right. And this really comes in terms of defining your trade before you get into it. Right. I get it. Sometimes, we all get excited, right, during the day when we see a setup and we're like, hey, this looks great and so forth. Right. You get into the trade and then what? Right. And then there's some emotion that happens once you're in the trade. So if you could define all this, even as you're getting into the trade, right, where's your stop price going to be? So one of the first things, just to kind of bring you through like a quick trade, but one of the first things, as soon as I get into a trade, right, I'm establishing my stop price every single trade I get into, right? I want to know where in my idea I'm going to be wrong, right? And this is where it's kind of the thick skin comes into play. Right? It's going to happen, right? Some trades are just not going to work out. So you've got to kind of come to grips with that.